All right, we're diving into the world of metallurgical coal. You know, the absolute backbone of the steel industry. And if you know anything about this space, you know it's famous for these brutal boom and bust cycles. But here's what's so interesting right now. Three major players are locked in this strategic showdown, and each one is playing a completely different game.
So that really brings us to the central question, doesn't it? In an industry this tough, this cyclical, how do you actually build a winning company? Do you build a fortress and just wait out the storm? Do you bet big on growth, or do you just try to buy out all your competitors? To figure this out, we're going to break down the strategies of 3 U.S. producers who have each picked a radically different path. So let's meet our players. First up, we have AMR, who we're calling the Disciplined Survivor. This is a company literally forged in the fire of bankruptcy. Then there's HCC, the high-stakes grower, a company that is betting its entire future on one single massive project. And finally, CNR, the strategic consolidator, a new giant that's aiming to win through sheer scale. 3 companies, 3 totally clashing game plans.
Okay, first up, Alpha Metallurgical Resources, or AMR. Their story is, well, it's one of a really dramatic transformation. After going through a pretty painful bankruptcy, they came out the other side with a single guiding philosophy: discipline above all else.
And this quote right here, it just says it all. The goal isn't empire building anymore. It's about becoming a resilient cash cow. See, AMR learned some really hard lessons from over-expanding, and now they are laser-focused on just generating cash from their very best assets.
And what's the result of all that discipline? Well, look at this number. Nearly $500 million in net cash. That means AMR is effectively debt-free. This isn't just a number on a balance sheet. It's a fortress, one they built specifically to withstand the very market downturns that almost crushed them before.
And that brings us to the core trade-off for AMR. Their strength is this laser focus on met coal. Plus, they have a huge advantage because they own their own export terminal. But the flip side? Their fate is completely tied to the market. When prices are high, they are just printing money. But when prices fall, all they can really do is hunker down and wait.
Now, for a complete 180 in philosophy, let's look at Warrior Met Coal, or HTC. They're taking the exact opposite approach to AMR. Instead of hoarding cash, they're funneling every spare dollar into a massive concentrated bet on growth. This is a true go big or go home strategy.
You could really sum up HCC's story as a classic high-risk, high-reward proposition. I mean, their entire future is hinging on one single massive project, one that could literally transform the company for decades to come. The scale of this bet is just staggering. Their Blue Creek mine expansion is aiming to boost production capacity by 75%. This isn't some small, incremental step. It's a company-defining leap of faith, and it's funded almost entirely by their own cash. But here's the gamble, right? The strength is obvious. Huge growth potential that isn't just tied to what the market does. The trade-off, though, is this immense concentration risk. Everything is riding on one project in one location. And as a very costly 2-year labor strike recently proved, that kind of focus, well, it can backfire badly.
And that brings us to our third and final archetype, Core Natural Resources, or CNR. This is a brand new titan, literally formed from a merger of 2 industry giants. Their strategy is different yet again: become the last one standing through massive scale and diversification.
The best way to describe CNR is as a powerful, diversified entity. Unlike the other 2, it blends that high-margin met coal with a steady, if less exciting, thermal coal business. The whole goal here is to build an all-weather giant, one that can withstand shocks in either market. Now, a key part of CNR's strategy is a kind of hidden growth that comes from these merger synergies. By targeting over $100 million in annual cost savings, they can actually grow through internal execution, not just by hoping for higher market prices.
So for CNR, the trade-off is really about complexity. Their unmatched scale is a powerful hedge, for sure, but it comes with some serious challenges. They have to manage the long-term decline of thermal coal while also navigating the monumental task of integrating 2 massive, distinct companies. Okay, so we've met our 3 players. Now let's put their strategies head-to-head so we can really understand the fundamental choices that they're making.
So here's how these philosophies really stack up. You've got AMR, the pure play, just focused on harvesting value. Then there's HCC, all in on a high-stakes expansion. And finally, CNR, who's playing the long game to consolidate and dominate. I mean, these are 3 completely different ideas about how to win in the exact same industry.
And of course, these different philosophies create very different kinds of risks. For AMR, the risk is almost purely external. It's the market cycle. For HCC, it's all internal. Can they execute the project? Can they manage their labor? And for CNR, it's a mix of both, from the internal headache of merger integration to the external macro headwind from the decline of thermal coal.
So we have the survivor, the grower, and the consolidator. 3 really compelling strategies. But here's the twist. When expert analysts actually sized them all up, they came to completely different conclusions about who is best positioned to win.
And that's the crucial question, isn't it? Which of these strategies really appears to be the most robust? Which company seems best positioned for long-term value creation, based only on the analysis from inside these reports?
And this is where it gets really fascinating. The 2 source reports we analyzed, they reached different verdicts. One concluded that AMR, the disciplined survivor, has the most robust and the cleanest playbook. Its combination of focus, a fortress balance sheet, and that key infrastructure gives it the clearest path to converting any market upswing into shareholder returns. But the other report favored CNR, the strategic consolidator. It argued that CNR's diversification, its unparalleled cost leadership, and that forward-looking merger strategy actually provide a superior, more resilient position to navigate the industry's long-term challenges.
So this leaves us with a fundamental question that goes way beyond just the coal industry. In any mature, challenging market, what's the winning strategy? Is it the disciplined focus of a pure-play survivor, or is it the diversified resilience of a strategic, scaled-up consolidator? The answer, it seems, depends entirely on which risks you're more willing to take.